A recession is looming, but will interest rates finally drop? Your savings and loans could be hit hard this year. Here, is what you need to know now. In most recessions, central banks lower interest rates to encourage borrowing and investment. This helps stimulate the economy by making loans cheaper for consumers and businesses. Lower rates usually ease economic downturns by boosting demand when spending slows. But this time, the story is more complicated because inflation remains stubbornly high, changing the usual playbook for rate cuts. Recent official data show inflation jumped 1.1% just in March and is 4.6% higher than last year. This higher-than-expected inflation means the central banks face a tough balancing act. Lowering interest rates could risk pushing prices even higher, so they are cautious about cutting rates quickly despite recession fears. Banks won't lend money in the federal funds market at rates lower than what they earn from their reserve balances held at the Federal Reserve. This interest on reserve balances, or IORB, sets a floor under how low the market interest rates can go. As a result, even if the economy slows, rates might stay elevated because banks have little incentive to lend cheaper than the Fed's reserve interest. The Bank of England recently kept interest rates steady at 3.75%. This is their lowest level since February 2023, down from 4% in December. While many expected further cuts in 2026 to fight recession pressures, the BOE is holding rates steady for now because inflation remains a concern. This cautious stance highlights the global challenge of managing inflation during economic slowdowns. You might wonder if cutting interest rates causes inflation. The answer is sometimes yes. Lower rates increase money circulating in the economy, which can push prices up if demand is strong. However, during recessions, demand typically weakens, so inflation does not usually surge immediately. This dynamic explains why central banks tread carefully when deciding whether to cut rates amid persistent inflation. For you, this means borrowing costs may not drop as much as you expect, even if the economy slows. Savings rates might stay higher, but loans for homes or cars could stay pricey. Keep a close eye on inflation and rate moves this year. For more updates on how this impacts your money, subscribe now and stay ahead.